All right, we're looking at the Skylar Vox case study on private markets. Let's scroll down and read question 1. Which of the two statements by Vox to educate Damon about the merger arbitrage strategy is or are most likely correct? A, both statements are correct. B, both statements are incorrect. Or C, only statement 1 is correct. Let's read until we get to those statements. Skylar Vox, CFA, is an event-driven hedge fund manager at Thornton Alternative Investments, which focuses on merger arbitrage strategies. Matt Damon is a potential client who doesn't have experience with event-driven hedge fund strategies and wants to know what are some of the benefits and risks of a merger arbitrage strategy. To answer Damon's concerns, Vox makes the following two statements. So it looks like these are the statements we are looking for, so we need to determine whether these are correct or not. Merger arbitrage strategy is relatively liquid due to the defined gains from idiosyncratic single security takeover situations. So for this first statement, we are relatively liquid, and that's because these are going to be for publicly traded stocks. So it's going to be when one publicly traded stock company is taking over or buying another publicly traded company. So check mark there, and then define gains from idiosyncratic single security takeover situations. That's also going to be correct. Basically, we're looking to take that spread. So our defined gain there is essentially kind of the spread between those two companies from the stock deal takeover. So statement 1 is correct. Statement 2, the strategy exposes investors to occasional downside shocks in the event that the merger deals unexpectedly fail. This is also going to be correct. So typically what's going to happen in these types of deals, the acquiring company, their stock is going to fall, and then the company being acquired, their stock is going to increase. And then we're taking a long position in the target and we're taking a short position in the acquirer. And so what's going to happen if it fails is the stock prices are going to go back to they were. So our short position, the acquirer, the stock price will go back up. And so we'll lose money on our short. And then on the long side, the target, we'd expect that stock price to fall back to where it was, so we're going to lose money on our long as well. So that's kind of how that downside plays out. So then we've got A, both statements are correct. That's what we're looking for. Both statements incorrect. Only one is correct. Answer A. Question 2. Which of the following statements would be the least accurate answer to Damon's question on the differences between the merger arbitrage distressed investing strategies? So I'm going to scroll, rather than reading these are pretty long sentences. I'm going to scroll up and read figure out the question first. So Damon would also like to know how the merger arbitrage strategy is different than the distressed investing strategy. After meeting with Damon, Vox goes on to transact on a deal that she's been monitoring. Okay, so that's pretty much it. Damon just wants to know the difference between merger arbitrage and distressed investing. So let's look at these answers. A, the merger arbitrage strategy offers relatively high Sharpe ratios versus the distressed securities investing strategy. This is correct. Merger arb typically will have a higher Sharpe, and that's mainly going to be due to the denominator in our Sharpe ratio calculation being the volatility. Merger arb is typically a pretty low vol strategy, which will lead to a better Sharpe ratio. So we're looking for least accurate. So since this is accurate, we'll cross off A. B, the merger arbitrage strategy employs a much lower amount of leverage versus the distressed securities investing strategy. This looks like it'll be our answer since this is inaccurate. Merger arb, as we've talked about in this question and before, is typically it's going to have low vol and not very high returns that go with that vol. So we need to use high amounts of leverage in order to kind of juice those returns and make the returns kind of worthwhile. So let's make sure we can rule out answer C here. The merger arbitrage strategy offers a steady return profile, yes, consistent with what we've talked about so far, while the distressed securities investing offers lumpy returns. this is an accurate statement. Distressed securities, it's going to be a lot more cyclical, and you're going to be kind of buying these companies when they're in really, really rough shape and then kind of pulling them out of that. And then typically there will be some kind of liquidity event there where then the value kind of shoots up. So those returns are going to be a lot more cyclical and lumpy. So we will stick with answer B. Question 3. What would be the most likely payoff of the merger arbitrage for Vox in case the merger is successfully completed? $275,000, $1.1 million, or $1.375 million. So for a successful merger arb, we're going to basically capture the spread between the long and the short positions. These should converge over time, and then we'll capture that spread. So we need to figure out what that spread is. After the meeting with Damon, Vox goes on to transact on a deal that she has been monitoring, the potential acquisition of 123 Petroleum by oil and gas. So we're going to be going long the target company, and then we're going to be which is 123 Petroleum, and then we're going to be going short oil and gas. The acquisition is a stock-for-stock deal, with the offer ratio being 1 share of oil and gas in exchange for 2 shares of 123 Petroleum. Just prior to the announcement of the acquisition, oil and gas was trading at $60 per share, while 123 Petroleum was trading at $18 per share. Soon after the announcement, 123 Petroleum's share price has jumped to 22, while Oil and Gas Inc.'s has fallen to 55 in anticipation of the merger receiving required approvals and the deal. At the current share prices of 55 for oil and gas and 22 for 123 Petroleum, Vox attempts to profit from the merger announcement. She purchases, so we're long 50,000 123 Petroleum. So we're long 50,000 at $22, and then we're going short 25,000 at $55. So we're going to be capturing the spread between those two. So our short position is going to be that 25,000 times the 55. And so that's going to be a notional of 1.375 million. And then our long, we're going to be at 50,000 times the 22 shares for 123 Petroleum. That's going to be a notional of 1.1 million. And essentially, we're expecting those stock prices to kind of converge over time after the acquisition goes through. So we should earn that spread between the two, which is going to be 275,000. Answer A. Question 4. What would be the most likely payoff of the merger arbitrage for Vox in the case the merger transaction fails to close? So I think we're going to be using all the same information here. And basically, we're going to calculate this based on assuming prices go back to their pre-announcement if the merger fails. So we've got here that oil and gas was trading at $60 per share, and then after the announcement, it fell to 55. So if the merger fails, essentially we're going to assume that we go back to 60. And then for 123 Petroleum, we're at 22 now, but we were at 18 over here. So if the merger fails, we're basically assuming oil and gas will go back to 60, 123 Petroleum will go back down to 18. So let's get our positions back in here then. So we were short 25,000 shares at $55. So if the price goes back to 60, we're going to lose $5 per share and lose 125,000. And then on our long position, we're long at $22. But we're assuming the price will go back down to 18, so that's a negative for us. So we would lose $200,000 on this trade. So we're basically going to add these two together then and get a total loss of $325,000. Answer C for our loss if the transaction fails.